Central banks were created to stop financial panics. Now they create asset bubbles on purpose. That sounds backwards because we're taught that central banks manage monetary policy to maintain economic stability, control inflation, and provide emergency liquidity during crises. But look at how central banking actually operates today, and you're looking at institutions that manipulate asset prices, engineer market outcomes, and coordinate global liquidity flows to benefit financial markets rather than economic fundamentals. They stopped being lenders of last resort decades ago. They became market makers of first resort. The cure became the addiction. Welcome to the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. When people think about central banks, they imagine conservative institutions that protect currency stability and prevent financial chaos. The language reinforces this narrative. Central banks maintain price stability, ensure financial system soundness, and provide emergency liquidity. This framing makes central banking seem like prudent economic management designed to serve public welfare. But that framing conceals what central banks actually do: manipulate interest rates and asset prices to generate specific market outcomes while using economic stability rhetoric to justify interventions that primarily benefit financial institutions and asset holders. To understand how radical this transformation was, consider what central banking was originally designed to accomplish. The Bank of England, established in 1694, existed primarily to manage government debt and provide a stable framework for commercial banking. It didn't manipulate markets or target asset prices. It maintained gold convertibility, regulated commercial banks, and provided emergency loans during genuine crises when private markets failed completely. The system was designed to be boring, conservative, and largely invisible during normal economic periods. The Federal Reserve, created in 1913 following the Panic of 1907, had an even more limited mandate. It was supposed to provide an elastic currency that could expand during harvest seasons and contract afterward, preventing the seasonal credit crunches that had destabilized rural economies. It was meant to serve as a lender of last resort for solvent banks facing temporary liquidity shortages. The Federal Reserve was explicitly not supposed to prevent all market fluctuations or guarantee asset prices. Markets were supposed to discipline risk-taking through price discovery, not central bank intervention. This original model had natural constraints that limited both central bank power and financial system risk. Central banks could only create money backed by gold or other hard assets, preventing unlimited monetary expansion. They intervened only during genuine emergencies when private markets had broken down completely. They let markets determine asset prices through supply and demand rather than policy manipulation. Commercial banks bore the consequences of their lending decisions rather than depending on central bank support. The system was designed to be self-limiting and market-disciplined. These constraints began eroding during the Great Depression when emergency powers became permanent tools. The Federal Reserve gained authority to purchase government bonds directly, manipulate interest rates more aggressively, and coordinate with fiscal policy to manage economic outcomes. What started as crisis response became routine policy as central banks discovered they could influence economic activity through financial market manipulation rather than traditional monetary controls. The gold standard's abandonment in 1971 removed the final constraint on central bank power. Without gold convertibility requirements, central banks could create unlimited quantities of money and credit to purchase any asset they chose. They were no longer limited to backing money with hard assets or maintaining fixed exchange rates. They became pure fiat institutions whose power was constrained only by political considerations and inflation concerns rather than mathematical limitations or market discipline. But the real transformation occurred gradually as central banks learned to use emergency powers for routine market management. Instead of waiting for crises to provide emergency liquidity, they began providing it preemptively to prevent market declines that might become crises. Instead of letting markets determine interest rates, they began setting rates to achieve specific economic objectives. Instead of allowing asset prices to fluctuate based on fundamentals, they began targeting asset price levels to support economic growth and financial stability. This shift was subtle but fundamental. Central banks stopped responding to market conditions and started creating them. Instead of providing stability through predictable rules and limited intervention, they provided stability through unlimited intervention and unpredictable policy changes. Instead of letting private actors bear the consequences of their decisions, they insulated financial markets from consequences through systematic intervention. The system inverted from market discipline to policy-driven. The transformation accelerated during the 1990s under Federal Reserve Chairman Alan Greenspan, who pioneered what became known as the Greenspan put, an implicit promise that the Fed would intervene to prevent significant market declines. Instead of allowing normal market corrections to clear excesses and discipline risk-taking, the Fed began providing liquidity injections whenever markets showed signs of serious stress. This created moral hazard where market participants could take excessive risks knowing that losses would be socialized through central bank intervention while gains remained private. The mathematical beauty of this system was that it appeared to reduce volatility while actually increasing systemic risk. By preventing small corrections, central bank intervention allowed imbalances to accumulate that eventually required even larger interventions to manage. Each intervention created expectations for future interventions, making markets increasingly dependent on central bank support rather than fundamental value creation. The system became addictive for both central banks, who enjoyed increased power and relevance, and financial markets, which could generate returns through policy anticipation rather than productive investment. The 2008 financial crisis revealed both the system's dependence on central bank intervention and its capacity for unlimited escalation. Instead of allowing over-levered institutions to fail and markets to clear at realistic prices, central banks around the world coordinated unprecedented interventions to support asset prices and maintain financial system functioning. Quantitative easing programs purchased trillions in government and corporate bonds. Interest rates were reduced to zero and kept there for nearly a decade. Emergency lending facilities were established to support markets that private capital had abandoned. But the interventions weren't temporary crisis responses. They became permanent features of financial system operation. Central banks maintained emergency policies long after the immediate crisis passed because removing them would have caused the market corrections they were designed to prevent. The emergency became the new normal as markets restructured themselves around the assumption of permanent central bank support rather than fundamental value creation or risk management. This created a feedback loop that explains central banking's complete transformation from crisis response to market manipulation. Markets became dependent on central bank intervention to maintain valuations that had been inflated by previous interventions. Central banks became dependent on continued intervention to prevent market corrections that would reveal the artificial nature of policy-supported prices. Each intervention required larger subsequent interventions to maintain the same stabilizing effects. The system escalated automatically without anyone making conscious decisions to transform central banking's fundamental purpose. Modern central banks now operate according to this interventionist logic rather than traditional monetary principles. They target asset prices rather than money supply. They coordinate policies with other central banks to manage global liquidity rather than focusing on domestic monetary conditions. They communicate constantly with markets to manage expectations rather than letting markets discover information independently. They view market volatility as policy failure rather than necessary price discovery mechanism. They have become active market participants rather than neutral referees. The European Central Bank illustrates how completely this transformation spread beyond the United States. Despite being prohibited from financing government deficits, the ECB has purchased trillions in government bonds through programs justified as monetary policy rather than fiscal financing. It has maintained negative interest rates and provided unlimited bank liquidity. European central banking operates according to the same interventionist model despite different legal frameworks. Central bank coordination during the COVID-19 pandemic demonstrated the global scope of this transformation. Instead of allowing markets to price pandemic-related risks and allocate capital toward productive responses, central banks worldwide implemented synchronized interventions to maintain asset prices and financial system functioning. They purchased government bonds to finance fiscal spending, corporate bonds to support business liquidity, and even equity securities in some cases to prevent market corrections. The interventions were immediate, massive, and coordinated globally without regard for long-term consequences or traditional monetary principles. The result is a global financial system that operates more like a managed economy than a market economy. Despite maintaining market rhetoric and institutional structures, central banks determine interest rates, influence exchange rates, target asset price levels, and coordinate policies to achieve specific outcomes rather than allowing markets to discover prices through supply and demand. They have become the primary price-setting mechanism for the most important financial assets in the world, government bonds, which serve as the benchmark for all other asset pricing. This centralized price setting creates systematic distortions that ripple throughout the entire economy. When central banks suppress interest rates below market levels, they encourage excessive borrowing, discourage saving, and inflate asset prices relative to income-producing capacity. When they purchase government bonds to keep yields low, they enable fiscal deficits that would be unsustainable at market interest rates. When they promise to intervene to prevent market corrections, they encourage speculative behavior that increases systemic risk. The interventions create the very instabilities they are supposed to prevent. But the system persists because it serves powerful interests effectively while maintaining political legitimacy through economic complexity that obscures wealth transfer mechanisms. Asset holders benefit from central bank policies that inflate valuations, while wage earners experience the costs through reduced purchasing power and limited investment returns. Financial institutions profit from predictable central bank support, while taxpayers bear the ultimate costs of intervention failures. The benefits concentrate among sophisticated actors, while the costs distribute throughout the population. Central banks also provide political benefits that would be impossible under traditional monetary restraints. Low interest rates reduce debt service costs. Bond purchases provide ready buyers for government debt. Financial system stability reduces pressure for structural reforms. Central bank intervention allows governments to pursue unsustainable policies longer than would be possible under market constraints. The intellectual framework supporting this transformation treats market volatility as inherently problematic rather than necessary for efficient capital allocation. Instead of recognizing that asset price fluctuations reflect changing information about economic conditions and investment prospects, central bankers view volatility as evidence of market failure requiring policy correction. They have convinced themselves and the public that smooth, predictable markets are superior to volatile, unpredictable ones, despite economic theory suggesting that volatility is necessary for accurate price discovery and efficient resource allocation. This anti-volatility bias explains why central banks have become systematic bubble creators rather than bubble preventers. By suppressing natural market corrections, they allow imbalances to accumulate that eventually require even more dramatic corrections or even larger interventions to manage. By maintaining artificially low interest rates, they encourage speculation and discourage the saving that provides genuine capital for investment. By targeting asset price stability, they create the very asset price instability they claim to prevent, but on larger scales and longer time frames. Understanding central banking's transformation explains many features of modern financial life that seem puzzling under conventional narratives. Asset prices don't reflect economic fundamentals because they're managed by policy rather than markets. Interest rates don't reflect saving preferences because they're set by central banks to achieve specific outcomes. Financial markets don't provide price discovery because they're insulated from consequences through systematic intervention. The problem isn't individual central bankers or specific mistakes. The problem is institutional evolution that transformed emergency medicine into chronic intervention. Emergency powers became permanent tools. Temporary interventions became structural dependencies. Crisis response became market manipulation. This explains why central bank policies produce persistent asset bubbles, increasing wealth inequality and systemic financial instability despite being designed to prevent these outcomes. The policies aren't failing to achieve their stated objectives. They're successfully achieving their actual function, maintaining financial market stability and asset price levels through continuous intervention rather than allowing market forces to determine prices and allocate capital efficiently. The lesson isn't that central banking is inherently problematic or that monetary policy should be eliminated. The lesson is that institutional purpose shapes behavior in ways often invisible to people operating within the system. Central banks evolved into market manipulation institutions while maintaining crisis response rhetoric because market manipulation became necessary to maintain the stability that justified their expanded power. Central banking will likely continue evolving toward greater intervention because intervention serves powerful interests while maintaining political legitimacy through complexity that obscures wealth transfer mechanisms. But understanding how central banking actually works provides clearer insight into why modern economies experience persistent asset bubbles, increasing inequality, and recurring instability despite sophisticated monetary management. The Spanish Empire discovered vast silver deposits but maintained monetary systems based on gold convertibility and limited government borrowing. The English system developed institutional frameworks that treated money as debt backed by productive capacity and parliamentary authority. The difference wasn't just about silver versus gold. It was about whether monetary policy served wealth extraction or wealth creation, whether money creation served consumption or investment, whether financial institutions served political power or economic productivity. Modern central banking followed the institutional model to its logical conclusion. Complete separation of money creation from productive constraint, conversion of emergency powers into routine policy tools, and optimization of financial system stability over economic efficiency. The system works perfectly for maintaining asset prices and financial market functioning. It works less well for efficient capital allocation and sustainable economic growth. But that distinction matters more than central banks want to acknowledge, because once you understand that monetary policy became market manipulation disguised as economic management, you stop expecting central banks to serve economic efficiency and start recognizing them as institutions designed to serve financial market stability, regardless of broader economic consequences. The policies are real, but the economics is political. And politics, unlike economics, serves power rather than productivity.